Hi, and welcome to the Value Momentum Investing course, Lesson 1, Stock Market Basics. I'm Adam Khoo, I'm your investment coach, and let me begin by congratulating you on making this decision to enroll in this program because it's a life-changing decision. And I'd like to also congratulate you on making the commitment, I hope you're going to make the commitment to finish this course and really apply what you learn, because when you apply what you learn, I promise you it's going to make a huge difference in your financial success. And review the material as many times as you need to. Ask questions by sending me an email whenever you have doubts, and apply what you learn immediately after you've learned it. Because what you're going to learn in this course is going to be everything that you need to become a successful investor and to build really a multi-million-dollar portfolio that's going to give you the financial security and freedom that you know you deserve. So if you're ready, let's begin this journey together. So let's begin with the most fundamental question. When you buy shares of stock, what are you really buying? You're not buying a piece of paper. What you're buying is you're buying the right to an ownership of a business and its profits. And a business is nothing but a money-making machine. So before you buy stock in a company, you have to know how many stocks are there or how many shares are there available in the first place. So for any given company, for example, this company I just made up called Success Company, you have to know how many shares are there which are outstanding. So for example, Success Company has 100 million shares outstanding. And what that means is that the company has issued 100 million shares in the market where people can buy and sell these shares. Or another way to think about it is the company is divided into 100 million parts, and you can buy any number of parts that you want. So for example, if you go to the market and say, hey, I want to buy 1 million shares. So if you buy 1 million shares, you now own 1 million shares out of a total of 100 million shares. So you own 1% of the company. And as a result, you're entitled to 1% of the profit the company makes and 1% of the voting rights. Because as shareholders, you get to vote on who's going to be on a board of directors, who's the chairman, what's their compensation. Now, of course, unless you own millions of shares, you really have no say. So for most of us, we're just buying shares to own, a part of the company, and we are along for the ride. Now, how many shares do you need to buy? Well, it depends on the market. In the US market, you can buy any number of shares that you want. You can start with a single share. You can buy 5 shares, 1,000 shares, really up to you. But in most Asian markets, you have to buy one lot of shares, and a round lot is usually 100 shares in most markets. So how do you find out the number of shares outstanding for a company? Well, you can get the information from any financial website. So my favorite would be finviz.com. It's a website I go to pretty often because it compiles the key financial data of most companies, and these are for US companies. So again, you can just put in any ticker symbol. For this, I'm looking at 3M. And over here, you can see shares outstanding. So this company has 591 million shares outstanding. So again, another way to think about it is that this money-making machine is divided into 591 million parts. Or it's kind of like a pizza has 591 million slices. All right. Now, a couple of things to look at would be, now what's the price of 3M at this point of time? Now at this point of time, you can see the share price is $210. That's the price of one share. So if you take the price of one share and you multiply this by the total number of shares, what you get? That's right, you get the value of the whole company, what the whole company is worth. And that is what we call the market cap over here. So the market cap of 3M is $124.6 billion. And that's how much it will cost if you were to buy all the shares, if you were to own the entire company. So once again, take the price of one share right now, the current share price, multiply this by the total number of shares, and you get the market cap of the company. Now, you can also see that 3M, for the last 12 months or the last financial year, it made $5.39 billion. That was how much money it made in total. So if you take the total income, 5.39 billion, and you divide this income by the total number of shares, what you get? That's right, you get the income per share, or it's also known as earnings per share, which is over here. EPS, earnings per share, which is $8.84. and TTM means the last 12 months. So you can see that for every one share that you own, you're entitled to $8.84 in profit. And again, the company could pay part of that money to you as dividends, cash dividends, or it could reinvest the money for you, and that would increase the value of the shares over time. So bear in mind that a company, the number of shares outstanding can change over time. So for example, a company could issue new shares. If it issues new shares, what happens is that there are more and more shares. It's kind of like you take the pizza and you divide the pizza into more and more slices. So the number of shares could increase, for example, from 591 million shares to 700 million shares, because the company created more shares and sold them to more investors. Now, in general, we don't really like that. Why? Because if there are more shares, it means that we have to share with more people, and each share will be worth less. We are diluted down by this exercise, right? So for example, if the company makes the same income of $5.39 billion, and we take that same $5 billion and we now divide it by more shares, what happens to the earnings per share? That's right, the earnings per share gets less and less. So in general, we don't like companies to sell more shares and create more shares, unless of course we believe that by selling new shares, the company can get more capital to grow its earnings, to grow its income, so that the pizza gets bigger and bigger. So even though each slice is smaller, or there are more slices, but because the pizza is bigger, there are more slices, each slice is still worth more. Okay. Now, on the other hand, a company can also reduce its shares outstanding by buying back shares, and we'll talk more about this in the later lesson. So generally, I love companies that buy back shares. When a company has got excess cash, they can use the cash to buy back shares and cancel the shares. And what that means is that from 591 million shares, if they buy shares back and cancel it, it could reduce to, for example, 400 million shares. Okay, so why do I like that as an investor? Because if there are less shares, it means I share with less people, right? So each share is worth more. So these are some of the key things that you can look at when you first look at a company. Next question, what is the stock market? So the stock market is a place where you go to buy and sell shares of companies that are publicly listed. Okay, and of course now it's not really a physical location per se, it's in cyberspace. So whether you're living in Singapore, in India, or Africa, you can go to the US stock market or the Hong Kong stock market every day by going online and buying and selling shares of companies listed in those markets through an online broker. So another way to think about it is that the stock market is like a supermarket of companies, where companies are on sale every day at different prices. On some days it's more expensive, on some days it is cheaper. Okay, and that gives us opportunities. Now, you can choose to buy many of the greatest companies in the world, companies whose products you use every single day. So you love to eat at McDonald's, you could buy a part of McDonald's. You love Apple, you could buy a piece of Apple, not the fruit, the company. You could buy shares in Amazon, you can buy shares in Pfizer or Burger King or any company in the world. So if you think about it, if you've always wanted to be an entrepreneur, you've always wanted to be a business owner, but said, I don't want to start a business, it's too much hassle, right? Well, the stock market allows you to buy and own successful businesses without the risk and hassle of starting your own business. I mean, a great example is Warren Buffett. Warren Buffett is known as one of the greatest investors in the world, one of the richest men in the world. He's got a net worth of close to $90 billion. You know what's the amazing thing? He made all that money without having to work in a job, without having to start any business. All he did was he started to buy shares of the greatest businesses in the world. At the age of 11 years old, he bought, as he grew up, obviously, he bought shares in American Express, shares in Coca-Cola, shares in Visa, shares in McDonald's. So today, if you go eat at McDonald's, you're making Warren Buffett rich because he owns part of McDonald's. You drink a can of Coca-Cola, you're making him rich because he's a bigger shareholder of Coca-Cola. So you can do the same thing. You can go to the stock market and buy shares of the best companies in the world. So if people start buying Apple computers, indirectly they are making you rich if you own Apple shares. So the beauty about the stock market is you can be an employee if you want, stay in your job, and yet enjoy the benefits of being the owner of several public listed companies. Now, understand that when you go into the stock market any day of the week by going online, and if you want to buy shares, there must be someone to sell the shares to you, another investor, for example. Okay? And if you want to sell shares, there must be someone who buys the shares from you. Fair enough? Okay, so in other words, for every buyer, there must be a seller. And for every seller, there must be a buyer. Now, some people ask, Adam, what if I want to buy a share and no one wants to sell it to me? Don't worry, there will always be a seller. There will always be a buyer. It's only a question of at what price. At the right price, there will always be a buyer and seller who's willing to buy and sell to you. But having said that, it is good if we focus on companies with enough liquidity. And what liquidity means enough shares that are transacted every day. Okay? So if you look at, again, any financial website, they'll tell you the number of average volume of shares transacted. So on average, I would say as long as the company has more than 200,000 shares of average volume, that's good enough. You don't need a lot more than that. But of course, for the famous companies like Facebook and Amazon, you've got millions of shares traded every single day. So it's really liquid, okay? Now think about it. Why does someone want to buy a share of a stock? For a simple reason, because they think the price will go up. If not, they will not buy it, true? Okay. So people who think the price will go up, we say that they are bullish on the stock. Okay, so say the word bullish. All right, so they are bullish. Great. Now, at the same time, why do people want to sell a share of stock? Well, for a simple reason, they think the price will go down. If they don't think the price will go down, they won't sell it, right? So in other words, people who think the price will go down, they are bearish on the stock. They are bearish. Well, it's just a term that we use in the market. Okay? So we said earlier that for every buyer, there must be a seller, right? And buyers think the price will go up. Sellers think the price will go down. So what does it mean? It means for every person who thinks the price will go up, there must be another person who thinks the price will go down for there to be a transaction. Okay? Because think about it. If everyone thinks the price will go up, who will sell? Nobody would sell. There'll only be buyers, right? And there can be no stock market. If everyone thinks the price will go down, who will buy? Nobody would buy. And again, there'll be no transactions and no market. So for there to be a market that exists, for there to be transactions every day is because there's always a difference in opinions. Some people think the price is going to go up, they buy, and others think it's going to go down, they sell to the buyers. So no one can agree where stock prices are going. It's an enigma, it's a mystery if you think about it, right? So every day is always a tug of war between the bulls and the bears, between the buyers and the sellers. So whoever is stronger on that day, at that moment, will determine the direction of the stock price. So if there are more buyers than sellers, demand exceeds supply, price goes up. When supply exceeds demand, there are more sellers than buyers on a certain day, price goes down, right? So very often in the short term, when you see the stock price going up and down, it does not mean that the company has changed in any way. It's the same company selling the same product, making the same profits. But what makes the price go up and down every single day is really the demand and supply of that stock at that moment in time. So again, share prices are driven up and down based on demand and supply, buyers and sellers. Now, here's the interesting thing. In the long term, in the long run, share prices are determined by a company's intrinsic value. In other words, what is the company really worth? What is the value of the business? So the higher the value of the business, the higher the share price will be. So that's logical, right? So what determines the value of a business? Remember that a business is a money-making machine. So the more money it makes, the more money it has, the more valuable it is. Fair enough? So in other words, intrinsic value is determined by a company's ability to generate sales revenue, net income or profits, cash flow from operations, the company's assets it owns, as well as its liabilities. So the study of a company's intrinsic value based on its earnings, its assets and liabilities is known as fundamental analysis, analyzing the business behind the stock. But here's the thing, in the short term, prices go up and down every day. Many times it has got nothing to do with the company. So in other words, the company could be making a lot of money, doing well, but the share price still goes down. Company may be losing money, but the price still goes up. Because in the short term, the stock market is not driven by logic, right? In the short term, stock markets are irrational. Stock markets in the short term are driven instead by emotions, right? Two kinds of emotions drive the market: fear and greed. Think about it. When people are fearful, what do? They just sell. They just sell in times of fear, like recession and war. So when people sell out of fear, what happens? The share price of a good company can still go down 10 or 20 or 30%, and the company becomes really undervalued. The price becomes undervalued at a discount. But at the same time, when people are optimistic, people are greedy, all right, the stock will keep going up forever. Yes, we're excited, and they buy like crazy. What happens? The share price can go up way above the true value of the company. It becomes overpriced, overvalued. And that's the time that you do not want to buy, obviously, right? So in the short term, what drives emotions? What drives fear and greed? And the answer would be news events and sentiment. For example, if North Korea decides to, start a war, or they say we're going to fire a missile, people panic, say, oh my God, there's a fear of a war. Or Donald Trump says, hey, we're going to impose more tariffs on China. Or there's this, Iran has got nuclear weapons. So, every month, every day, you have got all these news. And this news causes people to either panic and sell in fear, or get optimistic and buy. And that's what drives the price up and down, in the short term, depending on the emotions of the market, whether the market is bullish, optimistic, or bearish, pessimistic. So the study of the emotions that drive the price in the short term is known as technical analysis. So in order to maximize our profits in the short term as well as in the long term, we must both understand fundamental analysis, the business behind the stock, the logical thing that drives prices, as well as technical analysis, the emotions that drive the stock in the short term. Let's take a look at a few charts to better understand this concept. Now again, if you take any good business like Procter & Gamble or Federal Express or McDonald's, these are great businesses. Let's take a look at this company called Federal Express. It's a great business. Why? Because every single year its sales increases, its profit increases. It owns a lot of great assets. So again, in a good business, in the long term, the price will always go up because the company becomes more and more valuable, right? So you can see, if you take a look at the last 5 years, the share price for Federal Express went from about $110 to $240, okay? But again, the share price doesn't go up in a straight line. In the short term, it goes up and down based on the emotions of the market. So again, long run, price always goes up for a fundamentally good business. But if you zoom in to a shorter time period of a couple of months, for example, you can see that the price is driven by emotion. So for example, whenever there's fear or pessimism, again, whatever reason, it could be the threat of the Korean War, China trade tariffs, or some crazy shit like that, the price goes, oh my God, we're going down, oh my God, and people sell in panic, right? And the price goes down even though the company is still making money, the company is still growing. The price goes down because of fear. And then suddenly there's great news, right? Something happens. They say, for example, the US Federal Reserve is going to cut interest rates, or GDP was better than expected. Oh yeah, that's fantastic. And people start to buy and the price goes, all right, yeah. It starts to get bullish again. And again, this time now the price could be way above the value of the company. So again, you can see that even though the company's value increases over time as the company makes more and more money, as the company becomes more and more valuable, what happens is that in the short term, in other words, in a couple of months, the price goes through different trends based on emotions. For example, this is an uptrend when the price keeps trending up because of optimism, bullish behavior, right? And then the market or the stock can go on a downtrend over here because of pessimism, because of bearish sentiment. And then the stock gets bullish again all the way up, right? It gets bullish again, and then it gets bearish again all the way down. So that's how the market behaves. So again, in the short term, which means in a couple of months, share prices do not always reflect the true value of the company. Because in the short term, remember, share prices are driven by the current state of emotions in the market, whether the market is optimistic bullish or pessimistic bearish. And it's reflected in price trends, whether the price is on an uptrend or a downtrend. So to maximize profits, there are two things we need to know to have an edge in the markets. The first thing is we want to know what is the stock really worth? What is the intrinsic value of the company's shares? Is the price now expensive or is it cheap? And again, the study of this is based on fundamental analysis and it's based on logic. But then again, we must also look at what is the trend of the price movement. Is the market, optimistic or pessimistic? Is the market on an uptrend, a downtrend, or a consolidation? So this is the study of the emotions that drive the stock in the short term. And again, it's known as technical analysis. So let's take a look at how we can analyze a stock in two different ways. So first, using fundamentals as well as using technicals. So let's look at fundamental analysis. So let's imagine you analyze a stock called P&G, Procter & Gamble, and you discover through the fundamental analysis that the company's intrinsic value, let me write this down, intrinsic value is, for example, $42. Right? So based on the company's assets and liabilities and cash flow, it's worth $42. And again, in the later lessons, you will learn exactly how to calculate this intrinsic value. All right, so right now the intrinsic value is $42, but say the price of P&G is currently selling at, say, $39. Okay, so in other words, at $39, the price is undervalued. So logically, what should you do as an investor? Logically, you should buy, right? Because if you know it's worth $42 at $39, it's at a discount. So you should buy. Because you know that eventually it should go to $42. Make sense? Okay. Now at the same time, let's imagine that the price of P&G is currently at $50. So at $50, you know that it is overvalued. It is priced higher than its intrinsic value. It is overvalued. Right? So overvalued. So logically, what should you do? Logically, at $50, you wouldn't be a buyer. In fact, if anything, you may want to sell. Because logically, you know that it should come back down to $42. So you should sell. Right? Okay. So this is the logical way to invest. Again, this is based on fundamental analysis. Okay. But let me ask you a question. Is it possible that at $39, it is cheap, right? It's undervalued. But at the same time, in the short term, cheap could get cheaper. Is that possible? Yeah. So $39 could still go to $35. It could still go to $30. It could still go to $28. And so that's the danger with just looking at fundamental analysis, because you buy cheap, but because of the emotions, cheap could get cheaper in the short term. Now, at the same time, at $50, it is expensive, right? It's overvalued. But is it possible that expensive can become even more expensive because the market is optimistic? Yeah. So $50, the price could still go to $60. It could still go to $70. Does it make sense? Okay. So that's one way to analyze a stock based on fundamental analysis. The other way is to look at technical analysis, which is looking at the emotions that drive the stock by reading the price trend or the price movement. So let's imagine that you see right now Procter & Gamble P&G has this price pattern, right? It's doing this. The price is doing this. So what is this called? This is called an uptrend, right? Because the price is making higher highs and higher lows. So on an uptrend, what does it tell you about the emotions of the market towards the stock? That's right. People are feeling optimistic. They are bullish on the stock. And on an uptrend, prices are more likely to move higher. So what would you do on an uptrend? You would buy, right? Based on technical analysis. Now, at the same time, what if you saw that P&G, the price was doing this, right? So this pattern is known as a downtrend. And again, you're going to learn a lot more about this on the lesson on technical analysis. So on a downtrend, prices are making lower highs and lower lows. And it's an indication that the stock market is bearish on this stock. It is pessimistic. And on a downtrend, prices are likely to go lower, okay? And what you want to do? You want to sell. So that's based on technical analysis. Now, question, sometimes could you have a conflict between fundamentals and technicals? You bet. So in other words, imagine if currently P&G is selling at $30, right? 30 bucks. So based on fundamentals, what should you do? You should buy because it's undervalued. But what if it's on a downtrend? Then based on technical analysis, you should not buy. You should, in fact, sell, right? Now, at the same time, what if P&G was selling at $50? So again, based on fundamental analysis, it is overvalued. You should not buy. You should sell. But what if it's on an uptrend? Which means on an uptrend, it will tend to go higher. So you would buy. So which one do you listen to? Do you look at the fundamentals or the technicals, right? And the answer is it depends on your time frame. So if you look at someone like Warren Buffett, who's a long-term investor, he focuses only on fundamental analysis. He does not even look at the stock charts. All right? Why? Because he's a long-term investor. But at the same time, if you are more of a short-term trader, you're getting in and out really fast, then technical analysis is more important because you're riding the short-term trends in the market. You don't care about the long-term value of the company. So I always relate it to, for example, dating. So let's imagine you're a guy or you're a girl, whatever it is, right? And you want to date a girl. I'm a guy, I want to date a girl, okay? What is more important? The fundamentals of the person or the technicals of the person? So let me explain. So fundamentals means the person has got good character. This person, has got good values. This person over time will become more valuable, right? Better person, right? Now technicals would be things like emotions. So the person is hot. The person is cute. The person is attractive. Which is more important? So again, it depends. So if I'm going on a date for a one-night stand, although I don't do that in real life, but let's say if I'm going on a one-night stand, what's more important, the fundamentals or the technicals? The answer would be, of course, technicals, okay? So on a one-night stand, as long as the person is attractive, the person is hot, I'm going for it. I don't care about the fundamentals. If I go on a one-night stand, I don't ask the person, hey, can I check your educational qualifications? Can I check you have got good values? I don't care about that, just go for it, right? But if I'm in it for a long-term relationship, I like to marry the person, I like to bring the person home to my mother, then the fundamental analysis is more important. The person must have good fundamentals, have good values, and so on and so forth. So it's the same thing in the stock market. If you want to invest in a company for the long run, a good business, then fundamentals are more important, right? But if you're in it for a one-night stand, which is what I do in my short-term trading courses, then it's all about technical analysis. But I always say that the best thing to do is to find a point when both are agreeing together. In other words, the best stock is one which the fundamental analysis says buy and the technical analysis also says buy. In other words, if you find a company which is undervalued, at the same time it's on an uptrend, that's a sweet spot. And that is what I call value momentum investing, and it's the most superior kind of investing you can find. And that's what we're going to be focusing on in this program, combining the best of both worlds, the best of fundamentals and the best of technicals. And that's how you get superior results from other investors out there. All right, so let me further illustrate this idea with an example, a chart, right? So over here we've got P&G, Procter and Gamble, and P&G is one of those businesses that's a great business. It passes my criteria for a great business. And again, you're going to learn these criterias under the lesson on the 7 steps to value momentum investing and under fundamental analysis. Okay, so it's a great business because every single year they grow their sales, their net income, and their cash flow from operations. So this is a company where you're sure that in the long run, over time, it will always increase in value. Okay, so this green line that you see represents the value of the company. It rises over time. It represents the intrinsic value, what it's really worth based on its earning power. Now, again, in the later lesson under stock valuation, you're going to learn how to value a company's shares to know what they're really worth. But you can see that the share price, which is represented by these lines, these candlesticks, the share price doesn't always follow the true value of the company. Okay, so you can see that at times, whenever there's bad news, the share price can drop way below the value of the company, and that's when the stock becomes really undervalued. And you can see this happened during the financial crisis when people were freaking out. Oh my God, right? It was a recession, people were pessimistic, it was bearish, and the stock went all the way down to $35, right? When it was worth probably about $45. So it's really, really undervalued. Because remember, in times of fear, people panic and sell, and supply exceeds demand, and prices become really depressed. Now, on the other hand, you can see back in 2015, people were very optimistic, they were very bullish, there was a lot of good news, people were excited, they were buying, and because that the share price went all the way up, and the price was way above the intrinsic value. So this was when the price was very, very overvalued. All right. So in other words, visually you can see that anytime the share price is below the green line over here, that's when it is undervalued. So as an investor, the best time to enter is when you are buying below valuation. Okay, you're buying low, right? And at the same time, you can see that the share price, when it's above the green line, is overvalued. So these are the times that you do not want to be buying. Now, obviously, if you buy here, you're buying it when it's really expensive. Okay. Now, of course, in the long run, it will eventually go higher if it's a good business. But why would you want to buy when it's expensive when it's likely to correct back down before going higher? Why not buy when it's undervalued? Get the point? So, again, we want to buy when the share price is below or at least at the true valuation. Now, on the other hand, let me give you an example over here. Let's take this point in time over here. Now, this was back in 2018, right? So you can see at this point of time, the share price had a steep plunge all the way to about $77.50, okay? So I got a question for you. At $77.50, was it cheap? The answer is yeah, it's cheap, right? Because if you look at the green line, the intrinsic value was about $83 at this point in time, but it was selling at $77.50, so it was undervalued. But again, notice, although it was cheap, but it got even cheaper. It went down to $70. Why? Because you can see at this point of time, it was on a very clear downtrend. Based on a technical analysis, the market was bearish. The price was making lower highs and lower lows. So I don't like to buy when it's on a downtrend because, again, cheap can get cheaper, right? I like to buy when it is undervalued, but I see some bullish price action. I begin to see that the price is making higher highs and higher lows and reversing into a new uptrend somewhere about here. Okay, so you can see over here, this downtrend, let me use a red thing to draw. You can see this downtrend over here has begun to reverse into a new trend. So I like to buy somewhere over here at about $73. Now I can't always, get the bottom. No one knows where the bottom is. But as long as we buy somewhere near the bottom, as long as it's undervalued and it's starting a trend, the moment I get in, I start making profits immediately. See what I'm saying? Now again, if I were to buy at $77.50 Yes, I'm buying cheap, but cheap gets cheaper. Now you may say, but Adam, in the long run, it will always go up if it's a good business. Fair enough, but like I said, I don't like to buy something and see it go down in the short term and suck my thumb. Okay, I like to buy something and immediately I like to see, profits coming in as much as possible, so I catch the momentum going up. And again, under the lesson on technical analysis, you will learn specifically how to read these price patterns, right? The changes in the price action using trend analysis and support and resistance levels. So it's going to be really exciting to learn this stuff. So again, when you combine fundamentals, good businesses, undervalued with technicals, you get superior performance in the markets, and you can beat most other people out there in terms of getting the highest return on your portfolio, growing your wealth over time.